Okay, so you got the location. Now if I zoom out a little bit, okay. So again, you've got the building here, this old Common and the Elizabeth line. This is this massive train station that's being put in. It's the biggest train station in Europe in terms of this process. So this is only coming online in 2027, but this is going to be really significant in terms of the overall process. And then if I go a little bit further out, you've got the Elizabeth line coming down. And now I need to try and find the station. Where's it gone? It's about a 10-minute walk. Is this the station? No. Okay. I need to superimpose. But anyway, long story short, there's a station like sort of over here, which is the Acton station. Actually, it's probably this one here, Acton Central. There it is there. Okay, I've got it sorted. So there's Acton Central. That's on the Elizabeth line. So that takes 16 minutes to get to Canary Wharf. And that's about a 10-minute walk from the building down to this station here. And then just to be clear, it's 17 minutes from there to Heathrow. So again, one of the reasons why this area is so popular is because of its transport location. Now, let's take another look here. And what am I searching for? London tube map. Oh, that's not what we want. Okay, so again, I don't know how averse you are in sort of in reading this tube. But basically you got the central line, and if you look there, there is North Acton. So this is zone 2. So you got zone 1, central London. You got zone 2, you got zone 3. So what's important here is there's the tube station, North Acton tube station. And I basically went on this tube a number of times, but like to get to Oxford Circus, 16 minutes. And so to get into the, Marble Arch, Lancaster, Notting Hill, it's all extremely, extremely easy. Holborn, St. Paul's, which is the city, and Bank. So the Central Line is one of the best tubes. It goes often. There's a lot of tubes that go every 2 minutes. There's no breakaway here. Again, I don't know how much you know about this, but some of the, if you take like further down here, you can see how this line actually splits off. The green line you can see here, it splits off, and then it splits off, and it splits off. So you can only catch every third or second, third or train. Whereas here on the Central Line, you literally like every single tube that is going west, you can get on in terms of that process. So you've not only got access to the new Elizabeth line that can get you into the city and Canary Wharf in a record time, you've got access to one of the best tube lines, plus you've got that new station that's being built. So in terms of location, I was actually quite blown away by how easy it was in terms of the location and getting access to it. Then the next thing is, if we go here and I show you basically the building. So this is an apartment, like a sort of a video, or it's a website for the entire thing. So let's watch this little video. I'm assuming you can all see here. Okay, so I know people are saying the sounds a bit weird and whatever. It was just a song. So I can share this. Let me share this link in with everyone. So you can put the link in the chat. So you can literally go down here to video and you can watch it yourself. If you go to all of these things in terms of the brochures, etc., I mean, I think you kind of get the point in terms of the breakdown. But what is important is that this is a 54-story building. It's the tallest building in London outside of Canary Wharf. And they originally only had planning for 44 stories, but they managed during COVID to get an extra 12 stories, which is why it's so large. And I mean, the views are unbelievable, sort of 360 all the way around. Believe it or not, you can actually see all the way to Dover. Now, what's interesting is that the entire area has cranes all the way around it. There's construction all the way around it. And I'll come back to the map just to show you. I just want to show you some of these pictures, basically. So you can see all the different tube lines in terms of everything. So you've got Birmingham, you've got Heathrow, and then you've got all the locations in terms of where you're looking at. This area is having massive regeneration. So to give you an example, let me try and see if I can see it here. But basically, Imperial College is one of these buildings. It's a little bit behind this building over here. Now, Imperial College is the third biggest university in England after Oxford and Cambridge, and it's actually the most well-funded university. Do you see this building down the bottom here? This is Carphone Warehouse is head office. So Carphone Warehouse is a massive cell phone company, and the Imperial College has bought this piece of land, literally the plot next door. They bought it for £100 million, and they are putting up a £1.1 billion university facility right here. Like you don't get any closer. It's literally across the road. In terms of that process, this sort of just gives you an idea of what I was trying to tell you about North Acton, and then sort of where you can go in terms of the master plan. But I think you kind of get the feel for what is actually happening in the area, and there's absolutely large scale development happening all the way around in terms of the process. I mean, these are just pictures of the new station that's going to be live in 2027. It's the biggest station in Europe that's being built. I can't remember exactly, but I think it's got 16 different platforms and lines coming into it in terms of the process. So this is the Imperial College. This was the triangle building I was looking for. And as I said, they're literally building a thing right next door with $1.1 billion. So I'll share this with everyone so that you can take a look through in terms of the process. Now, why I'm showing you all this and why I'm excited about this is that the developer originally actually had this piece of land already. So this is where most of you should have seen the thing with Gary Sachs, where he started out in the furniture business, and then he started selling furniture to developers, and then he invented the 2-year rental guarantee, and then he created a management company which was called City and Docklands, and Life Residential. And Life Residential became the biggest management agent in London. It became the biggest private owned landlord in London. And that was then sold 2 years ago in terms of the process. But you're really dealing with someone that has done this at scale. Now, there's 770 units here. He is keeping personally 420. So he's keeping 420 units. And this tower, the Icon Tower, there's 120 units that are available. They are rented, everything is rented out already, so they're already furnished and rented, and they're at 98% occupancy. So I don't know if you just heard me correctly there, but 98% occupancy. So 770 units, and it's 98% occupancy, which is sort of unheard of for residential. But it shows you the demand in terms of the area and the location. I'm not going to worry with plans and everything else. I think that probably is enough. The only other thing I wanted to show you was if I go back to that map and I'll zoom in. So this here is the building, One West Point. This here is Icon Tower, so literally the opportunity. So it's the tallest building, and this here is the is where the Imperial College is going on this piece of land here. Like you basically don't get any closer. Like it doesn't get any closer than that. And there's development going on all around. There's development going on here. There's development going on here. There's development going on all over here. And these are large buildings that are being built. So this is a real high growth area, high density area in terms of what's happening in the area. Now, so that's what really intrigued me was the location, the opportunity, the transport. And then we sat down and we said, okay, because I went a couple of days before the buyer trip and I said, right, how are we going to participate in this? Now, there's two ways for people to participate. The one is that we do it the old school way through RPS, where people want to go and they want to buy an apartment. And if they do that, they can do the usual bells and whistles with furniture packs and rental guarantees. They've got a full solution from beginning to end, from the lawyers to the finance to the management solution to everything. So that's the one solution. The other solution was we're going to buy 10 units, and we're actually working with Gary, where he actually comes in and provides the surety on the financing, because believe it or not, his financing is fixed. I probably shouldn't tell you this, but his financing is fixed for 10 years at 0.7%. 0.7%. Like the rest of us in England right now are borrowing for about 6.5%. So I'm not saying we'll be able to borrow at 0.7%. If we could, it would be a dream come true. But even if he can help us borrow at 4 or 5%, it's better than 6.5%. So I was sitting with Jaco this afternoon doing all the modeling, because what we're wanting to do is, in partnership with Gary, we want to invest and own 10 units alongside him and then hold them for the medium to long term. Ideally, we won't even, so we'll have a 5-year term for investors, but ideally, we're not actually going to sell them in 5 years. As I just said to you, Gary is actually holding 420 forever, and for his family, for his legacy. And ideally, we won't sell them ever. But if people did want to sell after 3 or 4 or 5 years, we're just going to create a liquidity event on, using the platform where people can buy and sell out, etc. So I could probably talk about this opportunity for a couple of hours, because I really was quite blown away. I can see Anna is here. I don't know if there was anyone else that was there live. In terms of, there were about 20 of us that were on the ground and kind of spent the day with Gary and with Ian and also with the finance broker. And yeah, I don't know, Anna, if there's anything you want to add. I'm checking on the spot here in terms of that process. But I think all I would say for us investors is that obviously if people want to invest directly in their own unit, they can, and they can do it right now. If they're wanting to go in on the more fractionalized approach, we're still trying to finalize the deal. We're obviously trying to negotiate the best deal we possibly can on 10 units. But the key thing actually is the financing. Who stands surety on the financing? If it's us, then we're going to be borrowing at about 6.5%. If we can do a deal where Gary's coming to the table, then it should be significantly better. So yeah, I don't know if anyone's got any questions. Does that sum up a synopsis of what we found on the ground? Where is London in the property cycle? Rael, it's a good question. I would say right now, I've actually got a good slide for you. Let me go and find you a slide to sum it up for you. I would say generally the property cycle is a buyer's market. So what that basically means is that the buyers are the ones negotiating and sort of, they're the ones that got the power. So London and the UK has gone through challenges like in the rest of the world with interest rates rising. There's quite a lot of uncertainty at the moment in terms of the Labour government and the rules that they're bringing in. Certainly the buy-to-let investors are worried around some of the rules that are coming in, which is again why, I mean, as a mastermind member to all of you, I would always say we want to do this at an institutional level rather than actually, trying to do it ourselves directly. I'd much rather partner with Gary. He 420 units. I'd much rather we own 430 units and we partner with him than trying to do it on my own and kind of manage it on my own. But yeah, this is the slide I was looking for here, Rel. And for me, I would probably say the prices haven't really come off. You could argue maybe they've come off a little bit. There's a great piece of research that I like, which is Academimetrics. So this is the best place that I've found to be able to get Acadata. So it used to be called Academimetrics, which is how I remember it. But if you go here, you can always get the latest reports on everything to do with UK property, specifically residential property. And if I learned more about UK property from reading this than anything else. And you can literally go in here and you can see the report. So where's the latest report? Is this the boom, boom, boom? Let me just find you the report here. So they're up. So if you take UK property prices across the whole of the UK, you are 3.3% down. So that's what I was trying to tell you in terms of the overall process. So I would say we probably like somewhere here. It's fairly flat at the moment. Nothing's really changed. But then what's also important, that's for the UK in general. And what's very important here is you need to go to the regional comparison. So there's a lot of research that you need to look at here, but specifically you need to look at London. So if you look at London here, what are we looking at, chap? Sorry, I'm looking at this for the first time myself as well. So you can see here it was down 2.2, but between 2013 and 2018, it's up 31%. 2018 to 23, it is up 9.2%, and the total period, it's up 44% in terms of that process. So ranked growth, Southwest London in general. But anyway, you can get the point. There's one thing I just wanted to show you though, because I just don't know where to find it quickly. I need to look for it quickly. But when it brings out, here we are, press release. So this comes out monthly. So this is the report I was looking for. So what you're basically looking at, you can read all of this. I'm not going to read it all for you now. I'll tell you what I'm going to do. I'm going to put this in the chat box. So if people want to go and read it, they can. Like I told you, I learned more about UK property from reading this over the years than literally anything else. But generally, when you go into this, it actually breaks down the different regions. Here, this is what I was looking for. So Wales, England, East London. There we are. So if you look at the annual London change, it's down 6%, and monthly down 1%. So, and you can see there that the average price in December 2024 is 646. So this is what this is what's relevant. So, Raul, I hope I'm answering your question in terms of the opportunity. Now, some might say, and again, I want to come back to my slide here. Some might say, so I don't know, let's say we're sitting here. I don't know where someone wants to put the graph, but that's why I always refer to this, because what's important is that actually, because we're in this stage here, we've got quite a lot of opportunity to negotiate because it's a buyer's market. But what's much more important to me, having been through this cycle multiple times, is what are those fundamentals? What are those fundamentals of transport? What is actually happening in the area? All the other developments going on in the area. And I think one of the most important things, if I go back to this picture here, now where am I going to find you that picture? So it's not quite, you can't quite see the picture. But anyway, it's the tallest building. There it is. There it is. It's the tallest building outside of Canary Wharf. It's got 100, well, the whole development has 770 units and it's 98% occupied. And that for me is what's really important there in terms of that overall process. So I don't know if that answers your question, Rail. I'm trying to go into the detail for you. I think if we're looking at it from a short-term perspective, it actually provides a buying opportunity right now. I do like working with Gary because he is creative. He's not one of those listed companies that are kind of very kind of in the box in terms of the environment. And I'm definitely going to be proceeding with this. I really like it as an opportunity. And I do think with what you just said in the cycle, it actually provides us with a good opportunity to be a little bit more aggressive. You know, if they were taking this off to Hong Kong and selling 120 units on a weekend, which is what they used to do, then we would have no leverage, no ability to do fractional, no ability to lock them in, no ability to get them in the deal plus financing plus. So I actually see it as an advantage in terms of the process. The rentals. So we've actually got we've got a full schedule on all 120 units in terms of sorry, it's not showing it through. So I've actually got every single unit. I've got the size of the unit, the price of the unit, the rental of the unit, the current rental. I've got when the rentals start, the rental contract, and when they expire. So we've literally got all 120 units here. And so we're cherry picking the best 10 to take a portfolio of 10 properties. So, but you're looking at a yield to answer your question of somewhere between 3.5% and 4.5%, which by London standards is pretty much what you're looking at. Any other thoughts, questions, comments? You can stick your camera on, ask questions, speak, ask anything in terms of anything. Alex, what are your thoughts? I know you don't know London very well. Just for the record, Alex was supposed to be with me, but he's a bit of a terrorist from South Africa, so he didn't have a passport to start off with, which is one problem. And then on top of that, he has a South African passport, so he had to get a British visa. So I have a British passport, so I don't want these terrorists coming into my country. So I was quite relieved to hear that.
Yeah, you see, I don't actually know where I'm from. I'm not like Scott that has he doesn't even know which country he actually belongs to. You see, that's the big thing. And for the record, my passport expired the very first week in January. So it's not like it was that bad, okay? Well, firstly, I think the main point, Scott, is you just gave a masterclass on the UK. So I think that was a great session. I think we should do a webinar on that. So I've sent Shane some screenshots while you were doing that, and we should do a big event about that. Firstly, that's the first point. I think second point, we've been flirting with this project now for a long time, and as you mentioned yesterday, or I can't remember when we spoke.
Let's just put perspective. For 18 months, we've been trying to do a deal with Gary. And actually, to answer Rail's earlier question, there was another whole building that we were going to be involved in. I actually forgot to say this. And it was going to be off plan. So the problem is we would have bought and had to wait for 2 years until we got rentals. And then someone came in and bought the whole building. So there's no shortage of buyers in the market, but at scale, at institutional level, not at retail. And so yeah, I just thought it was weird, but I'm happy about that because he wanted to sell that first, and now all they've got left is Icon, and we get to invest in an existing building. I mean, Anna and I have walked to the top. We walked around the penthouse. It exists. I've seen the tenants. I've been in the gym. There's no artistic impressions. It exists. So yeah, it's the benefit of getting on the ground, though. To your point, Alex. Whenever you're dealing with partners, if you want to get shit done, sorry to be direct, but really you've got to get on an airplane and go see them.
Yeah, exactly. And I think that's the point I'm trying to make here, is we've been flirting for, you say, 18 months. But, if we even go back to when we were wanting to do that project with Ben, the UK has been like at just it feels like we've been chasing it, but it's been away. It's been like this far away from catching it. Like every single time we want to do something, it sneaks past us, and we miss the opportunity. And for a long time, we've been trying to do that now. So we I mean, I'm not saying US there's anything wrong with it. I personally, again, my personal opinion is there's a lot of stuff happening in the US that's good, but again, diversification. So we need diversification in the portfolios. So now that you've actually finalized things with what's his name again, Ian, and the details and so on and so forth, I'm very excited for that. And yeah, I mean, we've kind of built up a massive demand now in our community, and the mastermind members, everyone is sitting here for that. So I'm truly excited for those deals. And as you mentioned, we have now got the two options, right? If you want to actually own the asset in your name and actually, go have it and go live in it or go and visit, that opportunity is there through IPS that you've now finalized, and then also the fractionalization. So I think that's truly exciting, to be honest. And probably the thing that I'm most excited about is actually just getting this on the platform and taking it to scale, so we can get some more UK assets under management. So yeah, I'm excited for it.
Arthur, I can see your question about Lemon. I'll answer it once we've done Manhattan, if you don't mind, in terms of that process. So I'll finish with the last thing around London. It's quite interesting for those of you who do or don't know. I moved to London in 1999, and my friend and I tried to do our first property project in 2002. And I've always dreamed, because even I was very young. I was 24 years old. And we didn't have a deposit, and we battled to get financing. And I've always said, like, why can't we do this together? And I sat with chartered accountants, and I sat with MBAs, and I sat with lawyers, and they all said, no, it's not possible. People can't buy, property together in England, all the different regulations. And for years, and I don't know, for some of the South Africans, you'll know what I mean, but there's a company here called St. James's Land, and they would like run around. You'd find them in every shopping center. And it was the only way to invest in England from like 10, 15,000 pounds. And basically what they did is they sold a farm that was out in the middle of nowhere, and it was greenfield, and then people bought pieces of this farm, and then with the promise that one day they would become brownfield, which has allowed them to do developments, and everyone would make lots of money. Well, I mean, that business has gone out of business multiple times, but to my knowledge, they never actually got planning. And why I'm excited about this, and I apologize if I'm the only one, it's taken 23 years to allow people to actually invest into London in like reasonable amounts, be they 10, 20, 50,000 portions, and to do it alongside the partner. So anyway, it's just a little tale in perseverance, and when you're being told you can't do something, finding a way. Okay, let's pivot to Manhattan. So I'm going to do a proper webinar on Manhattan, but there's a couple of things that I wanted to show you here, which I think are important. So let me just get you the right website. Where's it gone now? Geez, I've been at a lot of websites open today. There we are. Okay. So if you remember, let's start with December. So if you remember in December, Garth Wellman actually came. And if you want to go and watch the recording, and I'm going to cut this, by the way, I just haven't had a chance to do it. Recording again. But if you consider that generally Anthony speaks for about 30 minutes, you can see Garth there. So let's just do the maths. There it is. Okay. So 25 minutes in, literally 25 minutes and 35 seconds, Garth comes online and he actually talks about Manhattan, and he talks about this opportunity. And he basically said that there are three ways to invest. There's equity. So that's where you invest as an equity holder in the development, and you own it. They expect the window period to be 7 years, and it's got a nice upside, but income only kicks in after, I think it's 2 years, etc. So that's the one option. On the other side of the fence, the other side of the pendulum, you've got purely debt, and that's a 4-year investment. It's a debt deal. It's secured against the property, and after 4 years, you get your capital back, but you've earned the debt for 4 years. And if you watch this recording, again, You hopefully all know where I went there, classroom recordings, 4th of December, but I am going to cut this video just for this short part where Garth was on here for 10 or 15 minutes. You can see here, he's still talking. Let's just see quickly. Yeah, there we are. So it's from 25 minutes till roughly 55 minutes. Okay, I'm going to write that down for myself so that I can find it quickly. 25 minutes to 55 minutes. So it's half an hour where Garth explains the development. He explains why he's so excited about the development, why he believes that the best option is to go with a blend. And so what the blend means is it's a combination of debt and equity. So if I go back now to where I was here, sorry, I've had so many websites open today. I need to go and close all of them. So if you go here, you can see that what we've basically done is it's a debt equity 50-50 blend. Okay, so the opportunity is based, this is the financial district, this is the stock market right here, the New York Stock Exchange. You're literally sitting 1.5 kilometers from that. So you can see that because it's a blend, you've got a total IRR. So if you just do the equity, and again, we're finalizing the numbers as we speak on the other two options. But if you just do the equity, the IRR is north of 20%. But if you do the blend, you've got an IRR of about 17%. It's a 7-year investment because half your money will be in debt and half your money will be in equity. And the blended cash flow, because again, it's half-half, is a net in your pocket of 6.34% in terms of the overall return. So you can see in terms of the risk, if you went purely equity, then it would be opportunistic because it's pretty much it's a development. But when you're going the mixture of blend and equity, it's value add. And if it was just debt, then it'll be core plus in terms of that process. Again, you can go and read about it. I'm not going to go through all of this. You can read about how it's broken down and how the loan versus the debt actually works. The market summary, you can read about Rivington in terms of the process, and then Callio private equity. What I would recommend more than anything is you can download the fact sheet in terms of, but what I would recommend more than anything, if you want the snapshot, you can literally read through everything, how it's been put together, all the economic performance, everything's here. But what I would do if I was you, I would watch that 30 minutes from Garth where he explains it. If you weren't able to be there in December, he explains it, explains why he likes the opportunity, he explains why he likes the blend. And my sort of takeaway on the blend as well was that what's nice is you're not just getting debt, you're getting debt and equity, but you're also getting income through the process. 7 years is quite a long time on the equity just to kind of only be in the growth phase. And there is some income that comes once the building's finished and it's earning income, but it's more of a capital growth option if one goes with just the equity option. So in terms of the timing, we've got all the numbers and all the projections and everything on the blend because that's what Garth literally focused on when we did it in December. So that's what the team has worked on. It's not that difficult to do just the equity and to do just the debt. And so they wanted to get the blend live, which they've done, and now they'll get the debt and the equity, the two ones separate if people want to do that. I would love to know, and maybe I should have done a poll. I don't have a poll here because we were debating internally whether people would be more interested in just debt and purely being able to get a fixed return, or if they'd just be interested in the equity, which is where they're obviously getting a higher growth but not a lot of income, or if they'd be more interested in the blend. And it was interesting. Like, we don't really know the answer, quite frankly. I know I'm more, and I'm not giving financial advice, but I'm more interested in the blend for two reasons, actually. One is because it makes more sense to me, and also with Garth being very close to this project and him recommending people to go with the blend, it kind of made sense to me in terms of that process. So Shona said, I like the blend, a bit of both. Yeah, I'd love to know what what others would say. Rael, I can see your question here, and I'm going to answer it for you. Where is that slide? So I'm just trying to think. I actually have that slide open. I'm just trying to think where it is, basically. boom, boom. Where the hell did I have that slide?
Scott, do you want me to address the Lemonway one while you do that, or do you want to first do that?
Actually, because I literally had these slides open today. I was showing someone I was showing you, Kelly, the breakdown of how the costs work. And so I actually have the slide open. I've just got to remember where to bloody find it. But yeah, go with Lemonway quickly while I answer Rail's question. He did ask it privately, but I'm going to answer it for everyone. He said, what percentage would Wealth Group take? What percent would Wealth? Yeah, so I'm going to talk about just the fees. So I'll talk to that. But yeah, Alex, you go wild.
Okay. So let me jump into the to your question, Arthur. Great question. I always like this question. So the simple answer is that Lemonway, well, firstly, I think the most important point here is that when we structured the platform, we wanted to be the platform completely separate from the money pathway, so that there was never any concern or any risk from a platform point of view towards money, meaning that we don't handle that cash. We're not a custodian. We're not handling the setting up bank accounts and so on and so forth. So when we started having this conversation, what was it, almost 9 years ago, if not longer, the very first questions that was discussed was which country would we go into, and we wanted to go into the European Union. And then from there, we decided to go with the digital wallet. Now, Lemonway actually is one of the biggest digital wallet providers globally, and the third biggest out of Europe. So the last time I checked, when Paolo met with them, I think last year, they said they've got over 11 million wallets currently live. So that just kind of speaks to how big they are. And they're our custodian. So they handle all the money movements and the KYC, KYB, and so on and so forth. So that's the first point at scale. The second point is they work with the biggest regulators out of the European Union. And from my understanding, what Paulo said to us, they're actually leading the charge in this whole compliance level. And probably thirdly, and most importantly, they work with the biggest institutional banks within Europe. So BNP Paribas, Barclays, Banco Sabadell, all of these different institutions. So that's where the money actually lies. It's in these accounts, and then they just have the licensing to manage these accounts on our behalf, from our clients' point of view. So I don't know if how's that landing for you? Maybe, yeah. What other questions do you have on that?
Yeah, I think the other part was around generally these guys sort of have a $50,000, limitation on liability, that kind of stuff. Is that standard here as well?
So I think, Arthur, if I understand your question, well, I don't know, Alex, if you got the answer to that, but they also are bound by European license, European regulation, and then on top of that, they work with some of the top banks in Europe, and it's actually the banks that are the custodian, and those banks, by European regulation, have those protections for citizens, which is, I think, what you're asking. Like in the US, it's $100,000. It's called the FIDC.
Yeah.
FIDC. And if a bank goes bankrupt, the FIDC still pays out the citizen 100,000. But if you've got 120, you lose.
Yeah. You lose the 20. Yeah. Yeah, that's a question.
So the point is that, yes, and back to Alex's point, we were originally in the Seychelles, and we thought it'd be cheaper and easier and everything else, but for two major reasons. If Shona came along and I said, "Hey, Shona, do you want to invest in London via the Seychelles?" she would think I was running a drug organization. Secondly, it doesn't have any of those protections that you just mentioned.
Yeah. Okay. Okay. Cool. Thanks.
Okay. For Rail's question, this is the slide I was looking at because Kelly and I were actually just going through our partner agreement. I knew I'd seen it today. So when you break it down, the way that it actually works is that upfront there's 3%, which is broken down. So this is actually more costs. So this is not profit; it's just cost to set up a deal. So we got the platform services. We got to actually set up the structures so that we got it in a tax efficient way. And then we got investor acquisition and marketing. So that's the way it actually breaks down in terms of the 3%. And then on the upside, so we basically built the model based on performance. So exactly the same as Airbnb, where we make money after the investors made money. So we have a profit share with the investor once they make money. So on the income if they make money, or on the capital growth if they make money. And again, just to be clear, if you go back to the Wealth Migrate platform, whenever you see the returns here, sorry, I should have this open, but I'll just keep going back to, I know I've got it open here. If you go look at the returns, this is all net. So this is net of fees. So it's what you're actually getting in your pocket, not what might be coming down the line. So hopefully that helps you, Rael, to understand. Just reminding you that if you do it on Private Wealth Global, there's actually a 50% reduction in those fees. But the minimum threshold is $50,000, which is the deal that we did with Callio Private Equity. So yeah, I think it's simple maths. If you've got 100 people putting in $100, the fixed cost to do a deal is still a fixed cost. Like, it doesn't change. So if someone's putting in a larger portion, the percentage portion towards the fixed costs are less. It's simple maths, like, if that makes sense. Hopefully that helps, Rael. And then Arthur, you said if you offer a pure play options, then investors can decide on how much to invest. Yeah, so that's our intention. We Alex and me and Paolo sat and we debated this at length, and we're like, do we just go blend? Do we just go debt? Do we just go equity? And then we thought to ourselves, it doesn't matter from the developer's perspective. We've got a little bit of time. It only closes in June. So we said, right, let's put all three up and then give people the option. And if one suits, and then, to be honest, if equity doesn't, like, if there's a very small portion of people that want to do equity, I'm just making it up, whatever, debt could be whatever, then we can give them the option to roll it into the blend or whatever in terms of the overall process. But we are trying to give people access to all three. Julie, I know you had questions, or you want to know more about Manhattan. I have already chatted with Paolo, and there's two things that I think are important. One is that I'm going to take that little clip that Garth did and put it up. And by the way, for everyone, when we put videos up, we put them on the platform, so you don't have to go and find them. It'll literally sitting here as the video with Garth. But what I said to Paolo today, I said, I'd love to do, once we got all three live on the platform, I'd love to do just a 10-minute synopsis of the pros and cons of, I mean, I think I've probably given it to you already, but just once he's done a little bit more of the number crunching so that we can actually do it. So we will do that. I just don't want to give you an exact time because I know he's just going back and forth, trying to understand some of the numbers, just to finalize the numbers. But yeah, I know, Judy, today you wanted to sort of get more info, and I just wanted to find out if for now you
did.
Info, yeah.
I had a bit of money sitting there, so I bought with what I had, but I just need to know if I need to put more.
Okay. Well,
yeah. So you know what the other options are.
Yeah, I would answer that. The first port of call I would, for everyone, if you're interested, is I'll go and do it tonight before I go to bed. I'll go and get that video from Garth. I'll clip it from when he started to when he stopped, so you don't have to go and find it. Well, I showed you pretty quickly how to find it, but I'll just cut it for everyone, make it easy, and then I'll put it on the Manhattan group. Sorry, on the mastermind group, and then people can just watch it if they're interested. Okay, Helga said, being a newbie on the platform and not having had the talk with Callio regarding what focus I should be looking at, I'm a little bit mixed emotions on, shall I start to invest more now once you release options on the platform, or shall I wait for the process you'll work with? Helga, that's a challenge that every single one of us has been through. And it's always an answer of, it depends. Look, I think, Alex, maybe you can help me here. I know that you've been working with Shanika to get people to be able to, meet with the Callio team and, kind of get that process going. I would personally, I've been doing this for 28 years, and so it was around December 2023 was that we had this opportunity, the first opportunity to invest in Manhattan. I've been investing in America since 2012. And we've never invested in Manhattan, not once, in terms of opportunity. So I would go as far as to say, Helga, if there was a small amount of money, like if you wanted to wait and kind of see your overall plan, which I understand, I would still personally put in a small amount just to get started and see how it works and kind of dip your toe, if you want to call it that. That'll be my gut feel. But the other ones, I mean, when I said the other two are coming out, they're coming out, certainly in the next couple of days, worst case the next week, so that we can compare apples with apples in terms of that process. And then, something like the London deal, I don't really want to put a time on the London deal because I'm going to be held to it. And there's something that's out of my control, which is negotiating with Gary and the bank on the financing. So I actually can't answer that. It's the one thing that's out of, I don't know the answer in terms of how quickly we can turn that around. I know they're hungry. I know they were very impressed by, the 20 odd people that were there on the buyer's trip and the questions that they were asking. So, everyone's pulling in the same direction, but how quickly the banks will move, who knows?
Scott, on that London deal, what is the basic structure of that deal? What is the business side? Is it pure equity? Is it debt? What's the power structure?
Yeah, good question, Garth. So that'll be I'm not going to complicate things. That'll be simple. It'll be an equity play. We'll be buying 10 apartments. I know Paolo did actually mention, and I don't want to confuse people, but he did actually mention maybe we should do a private debt play rather than waste time with the banks. I mean, legally we're allowed to do that. We've got the licenses to do it. I just don't want to confuse people. Like for now, it's just a simple Garth. I'm just going to pick on 4 people here. Shona, Judy, Garth, and Scott want to get together, buy 10 units. In the old way, we would create an SPV. In England's case, it's an LLP. We'd buy those 10 units. We'd negotiate a good deal, better than buying a unit on its own, because that's what you do. They're going to leave their equity in the deal, so we're going to be partners in the deal. If you know that's very important for me. We'll get financing ideally based on Gary's balance sheet. They'll manage it because they've got a full management solution already in the building, so we can make the management a lot more affordable. And then, as I said to you, ideally it's going to be a buy and hold long term, because I think this area, I think 5 years is actually not a long time. Like if you think about it, that station's only going to be finished in 2027, 2028. And if think about British railroads in 2027, just a guess. But it's the project managers in England aren't very good, so they need to up this.
And they build a sit and drink tea all day anyway. So anyway. Because obviously I was excited by when we had that mastermind with Gary last year on the London thing, and obviously it was all off plan at that time, and it was very encouraging. But obviously disappointing that it all fell through. So really now that we've got, like you said, on this buyer's trip, you've actually seen the bricks and mortar and it's there. I think it's awesome.
So let me show you what you're referring to. So again, if I just go to Asset Mastery, and the recording that Garth is referring to is, if you go to here, London Residential Large Scale. This is the recording that we did with Gary. So again, if you want to go and watch this, where he goes into more detail and how it works and everything else, that's what Garth's referring to. Garth, I'll be honest with you, and I know I sound like a salesman now, so I don't know how to do it without sounding like a salesman. It was better now than it was then, and for so many reasons. Like it's hard for any of you to get excited about the location when you haven't actually been there. Whereas when I stood on that roof 54 stories up, you've got a Google building literally like not even a kilometer, 500 meters away, where Google's spending $1.2 billion. You've got the railway, you've got Imperial College, you've got all the transport systems. Like, I could tell you all these things, but when you physically see them with your eyes and you see all the construction, and the hotel we were staying in was packed, and it's everything I've already said tonight. Like, and then the last part for me, that I don't really like buying off plan. There's a lot of risks that can come in, execution risk and whatever. Whereas when you're buying into a building that's already 98% occupied, you're reducing a lot of the execution risk. So I personally I was more pleasantly surprised by being on the ground than I was before I flew there.
Okay. Yeah, I mean, obviously, having lived in London, you know that's a very popular area. I was actually there last year in that area, visiting a friend. So the amount of expansion and development that's going on there is incredible. That Elizabethan line is just changed London, which is awesome. So, to be able to invest in London in particular has always been something that I've wanted to do for a very long time. Hence why I was at that meeting in Putney with you way back when in 2004, whatever it was. But yeah, okay, cool, awesome, it's exciting.
Yeah, no, it definitely is, and again, it's as I'm sorry, I'm repeating myself, but having a good quality partner is also essential.
Yeah.
I don't want to be going
Awesome.
buying 10 units and then we've got to try to figure out how to manage them and all that sort of stuff. I'm not.
No, that's a hack.
Yeah. So
Cool.
okay.
Thank you.
No, pleasure. Well, as I said, I met with Jaco literally this afternoon. Paulo flew over to London with me. So we're trying to crunch numbers at the moment. Unfortunately, with these things, to Gary and to Ian, and I'm going to say this with the nicest smile on my face, they're just old school developers. They build shit, they sell it, they hold it. So you come along and you're like, oh, we're going to buy 10 units and we're going to fractionalize it. And they're like, wow, that sounds amazing, but I have no idea what you're talking about. You know what I mean? So it's taking a little while just to kind of jump through the hoops. They want to do it. So the way I've explained it to him is that, Gary, you revolutionized the way property worked 20 years ago with the furniture pack and the rental guarantee. This is the new furniture pack. That's literally my sales pitch. So cool. I'd like to just pivot quickly and ask, has anyone got any questions around either the Wealth Weekend and or the structured notes today? Because I know, Anna, you sent me a comment, no, it actually wasn't you. It was Susanna who sent me a comment and said, look, it's quite overwhelming. And no, it actually was you, Anna. You did say it. Susanna also said it, by the way. And it was like, it's a lot of terminology, and I had to go and Google some stuff, whatever. I just want to say a couple of things about structured notes. I've known about them since 2019. Alex, you've actually spent quite a lot more time learning about structured notes than I have. And I've always, whenever it comes to structured notes, I tend to shy away in the corner because I really don't feel like an expert on them. They are difficult. They are a lingo that I struggle to understand. There's a lot of acronyms that get chucked in there. And every time I listen to Chad, there's a new acronym. So you asked the question today. There was some brand new thing that I'd never heard of before in terms of that process. So I just wanted to just give people a little bit of peace of mind around that. That it is a learning environment. I don't know, Alex, if you want to talk to that, because I know with your 5 Enneagram brain, you've spent a huge amount of time understanding structured notes. But I don't know, I do find them confusing. And I have invested in a couple of structured notes, probably 4 or 5. But I tend to rely quite heavily on my partners in terms of their understanding of what's going on. When you've got someone like not Anthony, Andrew. It's one of the reasons I like. There are structured note providers out there, but like Evan's thing with Investec, I can't tell the difference between a good one and a bad one. I'll be frank with you. So it's really important to have the right type of partners to be able to understand it. And I don't know if Evan's here, but I really enjoyed Andrew dissecting the Investec one. It was music to my ears. I was like, oh, Andrew, can you just come dissect all our structured notes in future? If they're not ours, if they're not yours, I mean.
No, I'm sad I missed that. I had to jump off at that stage. I'll have to watch the recording. I just echo everything what Scott said in terms of partners. I mean, Chad, from a alignment point of view in our business, and then also Andrew, I mean, we've literally been listening to them for the last, forever. It's just nice that there's someone that's not a stranger. They've broken bread with us. They've drank wine. They've drank many beers. So we know them quite well. We've shared a screen with them a number of times. So that's kind of one of the main things that we've defaulted to. I think the one thing that I just come back to every time, Scott, with the structured notes is that it's just a very nice and simple way that you can invest in companies that are listed, like, let's just use the example of the automotive industry. So we had a note, I can't remember, a couple of years ago, where it was all about, the theme of the note was all about car manufacturers. So there was a whole list of, it was VW, it was Tesla, I can't remember, there was 3 or 4 different shares.
I went through all of that today, Alex. They went through all of our different deals and where and what's happening and everything.
Okay. Anyway, so that note, I really enjoyed that note. The reason why I bring it up because it's just a nice way of referencing, like that was the theme of that note, and you didn't have to go and buy or start a trading platform or set your KYC up on a trading platform and then go find out what's the right price to buy Tesla shares or VW shares or whatever the case might be. You can just go into a note that is themed in that sector, and then you can invest in that structured note and have exposure directly to those companies through this. And it's not a volatile what do you call it, a volatile asset class. It's a very predictable kind of, I won't say safe, but I would say predictable within certain parameters. I'm sure that Chad went through the whole hard deck and safe, what do you call it, memory functions and all that. So I mean that's what it comes down to, and that's the way I like to see it. Is if you had to buy a building, you didn't have to go through the platform. You didn't have to go and actually take out a loan, buy the building, get someone to manage it, find the tenants. Exactly the same principles goes for a structured note. Instead of having to go and buy shares directly, you're just investing in a structured note that's basically putting it all together for you. And then even more to that point through the Wealth Migrate platform, we're just bringing the minimums down. So yeah, I think that's actually quite a nice way of looking at it.
I'll tell everyone a little story. I didn't really want to do it with Chad and Andrew there because Chad hates me sort of blowing his trumpet. But he started investing with us in Australia in 2011. Then he diversified into America in 2014, and he's quite a large shareholder in our company as well. And then he in 2019 came and he said, "Hey, look, you've been fractionalizing medical buildings. Why don't we just do this with structured notes? I've been investing with Andrew with structured notes. They're really working. I told you today already it was $2 million per investment." And he said, "Why don't you fractionalize that?" And I was like, "Yeah, we can do that. Our platform can do it. Our compliance can do it. Our wallet, everything." Like I told you, I didn't even know what a structured note was. And you won't believe it, but I actually came up with the name Cashbox. It was me. I helped them put that all together. Because they had the idea, they knew structured notes and how to fractionalize it, but I helped them basically build it into a business that people could use, if that makes sense. So anyway, that's a bit of a long story, but anyway, but fun. I should have just for all the marketing help I gave them, I should have said 5%, please, thank you, Sweaty. like the Google, you must have all heard of that story with like Facebook or Google where the sign maker, they couldn't pay the sign maker, so they got equity in the company. It was like the most valuable sign ever made. Cynthia said, "My daughter is doing uni in London next year. Does she get a discount on a flat if her mother's an equity shareholder?" Don't even joke. Cynthia, I did actually say that to them. I said, it would be fantastic if we could have some sort of like that, but they do everything for them as long-term lets. So they got all the facilities there. They've got concierge. They've got coffee shops. There was a little coffee thing that was opening on the following Monday, but everything they do there is long-term lets. So yeah, and as a shareholder, the problem is if mom's an equity holder, unless she owns the entire flat, her other equity holders might be a bit upset about getting a lower rental, if you think of it that way around. Rail said, "I don't see structured notes on the Wealth Migrate platform." We don't have one live at the moment, Rail. We're working with Cashbox. Specifically, they've had growth notes for the last 2 months, and we specifically want an income one to launch with them. So I did go through that today with some of the ones coming down the pipe, but we're aiming to have 5 or 6 structured notes with Cashbox this year. Sharon, will US investors be able to participate in the Manhattan deal, even though they can't go through Lemonway? I'll come back to you, Sharon, with regards to that. There's, my philosophy is where there's a will, there's a way. So I'll come back to you. I'll ask Garth specifically, and I'll come back to you as to how we can do that. Because obviously there are US investors investing, going through LLCs, etc. And let me just find out how to do that. Yeah. And I agree with you, Cynthia. To be honest, I'm one of the reasons I went to Wimbledon was I took a walk around my property that my friend Warren and I have owned since 2002, and it was actually embarrassing. I'm gonna let you all in on a little secret now. We haven't raised the rents once since 2002, not once. Well, because the rental, they were all just paying and the tenants were happy and everyone was happy. But then when interest rates went up and all the costs went up, like we weren't so happy anymore. Anyway, so it's been cash flow positive since day one and it's never had a void. It probably makes more sense now. But anyway, but the long story short was when I went in there and I had to like look at like what we're going to do with the maintenance and everything. Now, remember, I've just been with Gary in their building. And like it's a full solution, full management. I don't have to deal with Sky and DSTV and broken boilers and tenants and. I was like, I'm done. It's been 23 years, but it's time to sell this baby. So I literally have 3 estate agents right now giving me valuations and everything. I'm eating my. I can't think of the metaphor. It's too late. But I'm like now finally eating my own soup or whatever, where like my final mom and pop investment needs to go and be buried because I can't do it anymore. Like in comparison with where you've got proper professional managers raising the rent every 3% every year. You know, I just know I'm going to do so much better investing and partnering with them than I will be trying to manage it from bloody miles away and all that stuff. You know, so. Anyway, that's my. If you tell anyone else that story, I'll have to kill you. But when I joked with my uncle, he was like, "What? You've never raised the rent?" I was like, "No, we haven't." So anyway, that's my one little tale that I'm not going to make very public because it makes me feel like an absolute idiot. Anyway, cool. Anything else from anyone else? I know. So just on the Wealth Weekend. We've got Garth and Karen coming and Bianca. We're going to be doing, so it's actually really quite hard for me to even talk about this because I don't fully understand it. But what the Calio consulting team, which is Bianca and Karen, along with Anthony and Garth on the Calio Capital team, have been really building out the next level of Enneagram and wealth and using that to really help people facilitate. Then Garth's building 9. So if you remember the Enneagram Wealth, there's 9 different profiles. There's 27 tri-types, but there's 9 different profiles. They're building 9 AMCs. Now, I'm embarrassed to say I don't even know what an AMC stands for. So let me just go and Google it quickly for you. AMC stand for. No, it's not an American movie classic, so I'll have to go and look at my notes what that is. But yeah, effectively it's like investment vehicles. Now, what was so interesting talking to Garth was a couple of things. One is that AMCs are very tax efficient. They also take into account inheritance tax. So they're one of the most effective and efficient structures to be able to invest through. Then they want to basically build the 9 different AMCs that are designed with the right type of products to suit the profile for the Enneagram and wealth. So like, you know, depending on what your Enneagram and wealth is, then you're going to have the AMCs, and then it's going to help you with a balanced portfolio blend based on your Enneagram and wealth, your personal circumstances, and then where it's going. So in terms of the Wealth Weekend, some people in Johannesburg said, hey, is it going to be the same? It's going to be completely different because what we're going to do is in August, we spoke about foundational stuff, which was like the Enneagram and wealth and generational wealth, etc. Now we're getting much more operational in terms of actually executing and being able to participate in that. So the mastermind people are literally going to be the ones that are going to be the first to get access to it with time. So I don't know if you're interested in this, but with time, where Garth and I were going is that we're ultimately going to build the Enneagram and wealth into a fully automated process. We're going to tie that together with a robo-advisor. We're going to use AI. And ultimately, we want to democratize access to everybody being able to invest in a tax-efficient, cost-efficient way. But ultimately, you know, I've used the word, I'm sure many of you have heard me talk about smart investing. You know, you've got a smart watch, smartphone, smart everything. But imagine if you've got your personal profile, Enneagram and wealth, and your investments are married together towards your personal profile to help you achieve your outcomes. That's where we're going. So I just thought I'd let you know on that. So yeah, that's why I spent 2 days down in Stanford on Thursday, Friday. Actively managed certificates. Yeah, that's it, Alex. Well done. I don't like acronyms. Like when they have the ALM, asset liability modeling, I just call it a wealth plan. It's much easier.
It's just a secondary traded fund. That's literally what it is. So, I mean, that's.
It is, but
Yeah.
the beauty is that these are going to be built specifically with the Enneagram and wealth in mind, so that each one of the 9 profiles are taken care of. And then the other thing that I really am excited about, which I like because I can manage everything in one place, is that all of those AMCs will then be on the Wealth Migrate or private wealth platform. So everything will be able to take place in one place. So whether you're going through the private market or the secondary market, the primary market or the secondary market, everything will be able to take care of it. Also, what that'll do is those voice notes that I shared with you today from Garth, where there's opportunities in the secondary market, sorry, not the secondary market, in the private equity market. Sometimes you've got to pounce on an opportunity to get access to it. It's just a really good opportunity. You need to pounce. The AMCs will enable us to pounce on an opportunity, because you won't have to wait for Scott Picken to move his money and put it in Lemonway and close the investment, etc. The AMC will be able to take it down quickly. But we are playing with the big boys and the big girls now. AMCs are used for people investing millions of dollars. So back to fractionalization. Together, we can invest like the institutions. On our own, we can't. Is this valuable? I don't know. I could talk all night, but I mean, this is what I was doing on Thursday, Friday, and what we're bringing to the Wealth Weekend. And then on top of that is a lady, Judy, that Judy actually introduced me to, called Amy, and she's doing something similar to David in terms of the generational wealth space. So she's going to be coming down as one of our guest speakers, so to be talking about in the generational wealth space. What I really like about her, she's a lady that's in the space as well, and also has been through it, has got experiences actually in the consulting space. So yeah, Judy, thank you very much for that introduction. And she's actually currently looking at her flights, but will probably be presenting on Friday morning. Then my business coach, a lady called Sri Elliston, who's an amazing business coach, actually has a keynote and facilitates. She doesn't work with South Africans. She's like, no, yokes are too poor, too poor, too backward. So she only works in the first world. But I managed to, because of Paul O'Mahony, actually, I managed to wangle my way in there. And so she might be down in Knysna and has promised to do us a guest appearance. And just as my interest, who would like, in terms, so this is a presentation that, well, I mean, she's got workshops and everything, but she does this all over the world around future-proofing yourself and making sure that not only your business is future-proof, but you yourself are getting yourself ready for the future economy. It's a fascinating presentation. Obviously I've been coached by her now for the last 2 months as well. And I am actually trying to get her as one of our mastermind presentations. So I don't know, just thumbs up, thumbs down. It's not quite a structured note, but is that something people would be interested in? Okay, so I'm going to organize a private one for Shona, Judy, and Scott, because no one else put their hands up. Yes, Arthur, definitely intending next year, yeah, in terms of that process. So this wasn't exactly a fireside chat. This was more Scott and Alex lecturing around the fire. But is there anything else that we can help with? Anything that we can discuss? Any community conversation that I can help with? No? Dead quiet? Alex, we're gonna have to go and buy a book on, on what are those things? Oh man, I'm tired. When you like something breakers, what are they called? Where you like you basically, if you've got
icebreakers.
Icebreakers, yeah, you can buy little books on the icebreakers.
We can play those cards of humanity, and then we can send it around. I think that might be a good idea.
Anyway, Rael, I'm glad you enjoyed it. Shona, thank you. Yeah, look, if anyone's got any questions, please reach out to us. I know I sound like a broken record, but please, I would highly recommend that you go to the sheets, the accountability sheet, and use them. It's very, very important to do that. At the 12K Club, obviously, I sit with people one-to-one, and we do it every month. I do it for myself. And if you haven't watched that recording I did with Susanna in January, it's 1 hour long, and I literally summed up productivity in from everything I've learned from everybody. And it's probably the most concise I've ever managed to get it for myself even. And with that, it just explains how the five pieces work together so well in terms of that. So yeah, Susanna's actually got a whole network she's got called Thrive. So yeah, subscribe to her channel as well. But I think all I'm trying to say is that, use the tools, they're there. And if we can help, please, shout, and hopefully you're all noticing a difference. And well done to you, Alex. I don't think Shanika's here, but the work that you and Shanika have been doing to help gird everyone along and help them and find out where they're at, and, etc. But please use Shanika and Alex specifically and to help get results. At the end of the day, we're here for community, we're here for learning, we're here for knowledge, but the most important thing we're here for is results.
Scott, I might just want to add, I think the process is a lot smoother than what it was in the beginning. I think, for the new customers that come online, and I think the 30-day income challenge is something that's really facilitating that onboarding process that that makes, because like within a very short space of time, the whole thing can become real, and it makes a huge difference.
Yeah.
I just want to say that he's doing a great job on that one.
Awesome. Thank you, Derek. Well, that was Shane's break, so he deserves the credit.
Yeah, Derek, unfortunately or fortunately, the reason why it's so efficient is Scott wasn't involved. It was just me. So, that's why it's so well handled.
That's fine, dude. I look forward to you running the mastermind in March. I'll take a month's holiday. It's all good. I'm happy as anything. It's all good. Has anyone else got any? If you just want to chuck up your hand, or any questions, or any comments, or any thoughts, obviously this is community time. Such a zip quiet. Okay. Well, if we don't, then I think let's wrap it up for the evening. Thank you to everyone for your time. I hope you enjoyed it. And just a reminder that the next session is the 12th of March. So it's not quite a month, because this one got extended a little bit in February because I was in England, and the other one is extended a little bit on the other side because of school holidays. So it's only about three and a bit weeks between. So you're going to have to boomer this month to get results. So, but anyway, we'll lovely to see you all online, and I hope we see as many as possible at the Wealth Weekend. Come and enjoy Alex and I's hometown. It's very beautiful, and like I've been doing for a few of you in England, I'm just going to start teasing you. I was like, just going to send beautiful pictures all day long until you're jealous enough to come. Okay, everyone. Night.
Thank you.
Cool. Thanks all. Bye-bye.